most of the investors in the tier 1 cities get very well serviced. And that's not to say that many of us are not trying our best to service investors in tier 2, tier 3, but without using technology to have a wider range of services available to a wider range of audience is that much more difficult.
So one is that category of clients who are very super bullish on equities and they will remain. So for them, it's always an opportunity like now where they want to invest more. So they want to go all in because they feel that market has consolidated for last 12, 18 months. And now there's be the new way of, or the trajectory where the markets can go up. And obviously there'll be certain things which have also happened in last 3-4 months like GST cuts, a lot of positivity in the markets, etc. The other camp is someone who was always circumspect that whether it will do well or not do well. They have started doing a different sort of allocations as well because they might are thinking that whether I did a right thing of investing in equities and whether I should have done fixed income. So their allocations have started moving toward fixed income, InvITs, gold, etc. And also what Rajesh alluded, I think we also speak a lot on asset allocation. And I think that is the best mechanism from risk management point of view, right allocation point of view. We keep saying that asset allocation is the best check for your emotional quotient also because at the end of the day, beyond a point, IQ does not work in markets, it's EQ. And if you have a right asset allocation in this current times, you can move your debt to equities. But if you're fully equity allocated, then it becomes difficult. So from that perspective, I think there are clients who are super bullish, who wants to continue investing. They find it an opportunity. But they are set also now who wants to diversify into the different categories because they are saying that in last 18 months, it has been almost zero. So whether I want to do something different, that is something in their minds now.
Then we use Microsoft Copilot, where we feed in all data and we've been training our machines, any detail of products across all asset classes. Because many relationship managers are not fully trained. They can get all the information, comparison, and now we are integrating it with our mobile app so that even a client can get all the information he wants. He need not call a relationship manager to ask him, hey, listen, I need some money off my portfolio. Which fund should I redeem?
The next day I get a call from their EA saying that, can you give me that is my account number, so that they want to transfer the money. That's not how it works. There's a whole due diligence, SHA, all that stuff that you have to go through and then invest. So there is a lot of beyond the core businesses for the traditional families. I mean, Rajesh and everyone who sits here, they play a huge role in educating about these asset classes, what is there in the market. Such a huge role because many times they're so focused on their core business, some of the other opportunities may not get their attention.
The domestic wealth management industry is undergoing a remarkable transformation. As the country's economy expands and the affluence deepens, the number of high net worth and ultra high net worth individuals is growing faster than ever. So today we discuss how the space is evolving with some of the key stakeholders from the wealth management space. I would like to begin with Anas, who, if you can set some context as to how this space has evolved and how the number of HNIs and HNIs has been going up.
Hi, thank you. Thanks for this opportunity. So we published something called the Hurun, the Wealth Report, which is trying to understand the distribution of millionaires and millionaire households and macro level wealth creation across the country. And initially we used to do it every year, but then we thought we'll take a break and give a pause into it, give a 2-year gap and then do it, because these are sort of numbers which you can say and you cannot really go and count. So whatever we say, it has to be backed with some kind of assumptions. So to 2021 was when we launched the most previous report, and that time we found about 4.5 lakh millionaire households in India. And fast forward 2025, which is a report that was launched just last month, that number has doubled to almost 8.5 lakh households, millionaire households. Now, during this time frame, the GDP of India grew by almost $1 trillion, right? And some of the other numbers that I can share with you, which is kind of representative of how things were, right? For example, the number of billionaires during this time frame in the Hurun Rich List. That's grown from 220 to almost 360. That's grown by almost 50%. Or if you look at the number of individuals with rupees 5,000 crores net worth, which we could find, and we would have missed a lot of people as well, that number has grown from 324 to 581. So that number has grown as well. And so that all that happened when India's GDP grew by $1 trillion in the last 4 years. So, and we, based on the current growth rate, the GDP is projected to hit almost 6 to 7 trillion by 2030. We don't want to say double and all that, but 6 to 7 trillion, right? And that's an addition of 2 trillion. For that 2 trillion addition of GDP to happen, we estimate the number of millionaire households has to grow double the size of current levels in the next during that time frame. So I think from a wealth creation standpoint, the wealth improvement standpoint, it's really the India is on steroids. That's what we think.
Yeah, that would be music to the ears for.
We should invest in all these companies when they go public.
But Rajesh, if you can tell us, how does this compare to, like, say, mature markets like maybe the US, and have we like barely scratched the surface, or how's the market look? How does the market look like compared to some of the matured markets?
So I'll just compare it with the US. India has about 1,600 odd billionaires. The US has close to 11,000 odd dollar billionaires. When it comes to HNIs, we have about 550,000, 6 lakh HNIs, which are dollar millionaires. And the US has close to 34 odd lakh of dollar millionaires. And when we define ultra HNI, anyone with $25 million worth of net worth, India has roughly 45,000 and the US has 3,20,000. And outside the top 10 big wealth management firms in the US, if you take all the big names, JP Morgan, Morgan Stanley, there are 250 wealth management firms itself catering to that market, which is 8 times the size. In India, all the wealth management firms put together, we are about 25, 30 odd if you include the banks. So huge growth pathway for growth. And both HNI, ultra HNI are growing at about 8 to 9% in India itself. So there's a big runway for growth and for all wealth management firms.
Thank you. Rahul, we saw Rajesh and Anas throw some numbers at us. Are you also experiencing this in terms of your business, and how is it shaping up?
Yeah, very similar. And I must say, Anas, since you think India will have more millionaires and billionaires in coming years, you should publish a report every 6 months, not a year. And you should not take breaks since it's anyways on steroids. I think very similar in terms of what we are also experiencing. This whole trend of financialization from investment point of view is happening in the last 10 years. At least in the first 5 years, we used to see a lot of younger people adopting into the newer asset classes like mutual fund, equities, etc., and were trying to experiment more. But what I've been seeing, at least in the last 3-4 years, that the older generation, which was more glued to the traditional classes like real estate, gold, fixed deposits, they are coming with loads of money and saying that what should we do with this? For example, I meet a lot of clients who come and say that I've sold this parcel of real estate in Gurgaon or Chennai, and what should do about this money? And I say that is a far accelerator in terms of leading to more wealth generation or more investments in the financial side. Because from wealth point of view, the older you grow, the more you have from investable point of view. And earlier, I think the younger generation who came had a lower investable surplus. So when the older set of people come in, I think it accelerates the journey more faster from the wealth point of view and for the whole financial issue point of view.
Thank you. Shrikant, I would now like to come to you. You're a new firm which is growing well. Can you tell us what made you foray into wealth, and what are the how has been the journey so far?
Look, I think the why part of it has been answered by my fellow panelists. I think the way the market is growing, the way we are seeing newer sort of entrance into the investing space, whether you look at it from a demat growth point of view, you look at the new as folios growth, I think that part is now well established. Where we thought that there could be an interesting play also is the intersection of what happens when domain meets technology. And I think that's one area that we intend to sort of explore a bit further and see if we can expand the market more horizontally. And there are two reasons for it. One, from an investor point of view. Most of the investors in the tier 1 cities get very well serviced. And that's not to say that many of us are not trying our best to service investors in tier 2, tier 3, but without using technology to have a wider range of services available to a wider range of audience is that much more difficult. Two, from a point of view of wealth management itself, it's a very interesting industry, and most of my fellow panelists are veterans, and they will sort of also concur with this, that it's a unique industry where the cost structures are similar to an investment bank and revenues are similar to an asset management. And till about half a decade ago, it wasn't the case. You had extremely high front-ended costs and you had extremely high front-ended revenue. But over the course of the last 5, 6, 10 odd years, the regulator has made sure that for the purposes of alignment of interest, most of the revenues in wealth management industries are now back-ended in nature. So for all of us to add productivity and efficiency, you need to start moving towards keeping your operating costs in check. And one of the best ways to do that is technology. So for us, I don't think we're trying to do anything unique or remarkable. We're just trying to take some of the more logical manifestations out here, adding productivity from a wealth management point of view, and adding choice of services to customers, which you otherwise will feel difficult to cater.
Thank you. Now let's learn how have been the investment trends amongst HNIs. Rajesh, I mean, a lot of your clients would require advice, some hand-holding, and we have seen the equity markets go through a volatile period. So how has their behavior changed? Are they now pivoting towards gold, or what is the interesting trends that you're picking when it comes to...
So we are largely in the ultra HNI space now for close to 40 years. The behavior with ultra HNI is a function of their experience in the market. If they've seen 1 or 2 bad cycles, patience level is much better. Our model always is around asset allocation, so not chasing a particular asset class. And the concept of asset allocation comes in only because we know that each asset class works differently during different phases of time. So there are times when equity doesn't do well, but then you have fixed income or other asset classes that are providing the returns. So in the last 1 year, markets have consolidated. Some good fund managers have still delivered 8-10% return. And there is patient money that is waiting in the sideline to see if there are any deeper corrections. So no one's taken any cash call. People have remained invested. Yes, there have been certain asset classes that have done well. So last 3-4 years, for example, we've added gold in all client portfolios. Last year, we added a little bit of silver, which is just 5 to 10% of the portfolio. Fixed income threw up lots of opportunities when equity was flat. So on the alternate fixed income space, between private credit, real estate funds, real estate NCDs, long-short funds, there are lots of new investment vehicles that are delivering 8 to 12% kind of return that many clients invested. And last but not the least, as a model of asset allocation, we've always proposed 10% of their portfolio allocated globally. So for the last 4 years, we've invested in the US and continue to have a portfolio outside India through LRS route. That itself has done very well. So by just focusing on asset allocation, we are able to manage all the ups and downs variations of each asset class.
Yeah, thanks. Rahul, what are the kind of queries that you're getting with the markets not going anywhere over the last 12, 13 months?
So, I would say that what Rajesh also spoke. So I would say that there are 2 sort of clients, at least when we look at when the market has been very stagnant for last 12-18 months. So one is that category of clients who are very super bullish on equities and they will remain. So for them, it's always an opportunity like now where they want to invest more. So they want to go all in because they feel that market has consolidated for last 12-18 months. And now there's be the new way of, or the trajectory where the markets can go up. And obviously there'll be certain things which have also happened in last 3-4 months, like GST cuts, a lot of positivity in the markets, etc. The other camp is someone who was always circumspect, that whether it will do well or not do well. They have started doing a different sort of allocations as well, because they might are thinking that whether I did a right thing of investing in equities and whether I should have done fixed income. So their allocations have started moving toward fixed income, InvETs, gold, etc. And also what Rajesh alluded, I think we also speak a lot on asset allocation. And I think that is the best mechanism from risk management point of view, right allocation point of view. We keep saying that asset allocation is the best check for your emotional quotient also, because end of the day, beyond a point, IQ does not work in markets, it's EQ. And if you have a right asset allocation in this current times, you can move your debt to equities. But if you're fully equity allocated, then it becomes difficult. So from that perspective, I think there are clients who are super bullish, who wants to continue investing. They find it an opportunity. But they are set also now who wants to diversify into the different categories, because they are saying that in last 18 months, it has been almost zero. So whether I want to do something different, that is something in their minds now.
Anas, you deal with a lot of data. So the young cohort, is there some peculiar pattern there when it comes to their asset allocation or their portfolios? Are you picking any different trends, various generations? Or
No, I would just add, I don't manage wealth, so I can just add based on my interactions with some of these young entrepreneurs and family businesses. So I invest in a lot of startups. So I was just talking to one of the next generation entrepreneur of a fairly large $3-4 billion net worth family, and I was telling them that, oh, I'm going to invest in a startup. At least you should start allocating some money, because if I'm investing, say, X, you should at least put 2X. That is your way of giving back to the nation, sort of thing. So they are a large real estate company. Then I told them, this is the company which I'm going to invest in. The next day I get a call from their EA saying that, can you give me that is my account number, so that they want to transfer the money. That's not the way it works. There's a whole due diligence, SHA, all that stuff you need to go through and then invest. So there is a lot of beyond the core businesses for the traditional families. I mean, Rajesh and everyone who sits here, they play a huge role in educating about these asset classes, what is there in the market. Such a huge role, because many times they're so focused in their core business, some of the other opportunities may not get their attention.
Shrikant, your ticket size is relatively lower. So do you see a change in behavior when it comes to different age brackets?
So we cater to two kinds of customer cohorts. So from the wealth tech point of view, we range anywhere between 1 to 25 crores. And on the ultra high net worth, which is something that we've done over 2.5 decades, is where we started 25 crore plus. But one of the things that we were very focused on is we don't want to have differentiated offerings to both these customer segments, because that's something that has been the peril for a very long period of time, that you have smaller wealth and hence you will be treated differently, your service levels will not be that good. And I think one of the things that some of the big techs have shown us, and I'll take a classic example of Amazon. Even if you're an Amazon Prime member, your UX is pretty much the same. You may have certain other advantages like same-day delivery, or you may get certain discounted benefits, but it doesn't mean that your color of your app changes. You are not made to feel good or bad basis the amount of purchase that you make on Amazon. I think it was time for Indian service industry also to embrace that. So for us to have a change in terms of customer cohort was not to actually differentiate between those two customers, but actually to say that if we have successfully advised some investors over multiple decades on the 25 crore plus segment, going all the way up to $1 billion at times, can we bring some of those? Because all human beings behaviorally are aspirational. They want to achieve what some of the other richer investors have been achieving. So I think using technology, using regulations, we are trying our best to fractionalize some of those investments to the cohort, which is 1 to 25 crores. And there we have adopted an omni-channel approach, where the client is free to choose between choice of an app or choice of an RM. 25 crore plus, emotion does take better of you. And when you're about to make a significant exposure into an investment, you do require that human validation to check. So I think the way we do it is we diligence the product almost as if it is suitable to the very best out there. And we try our best using regulatory frameworks like accredited framework, SIFs, or certain other technology available to see can it be made available to a wider mass. And it is something that internationally, using omnibus structures, using blockchain, is now being done. So I think as far as we are concerned, one of the other things that we have as a philosophy, and I think Rajesh, Rahul, everyone spoke rightly, I don't think any wealth manager worth their ilk will ever contest against the age-old asset allocation. The only other thing that we try to add on top is also to minimize information arbitrage. I think one of the biggest issues that we see is in a herd mentality kind of an approach, and Anas just gave the example. I think one of the biggest things that we take as a responsibility for us is for every new asset class, every new product out there can be minimized information arbitrage. And there are so many complicated products, right? I mean, SIF looks simple because it's coming from AMC, but it has almost 20, 30, 40% exposure to instruments which are not the most simple to deconstruct or demystify, whether it's early stage investing, whether it's private credit, whether it's private equity. So in addition to suitability and asset allocation, if each one of us can just raise the bar on minimizing information arbitrage, I think we will cultivate a much better wealth management ecosystem.
So yeah, technology has been a great leveler, and it's heartening to learn that even in the wealth management space, the same thing is playing out. But Rajesh, a firm like ASK, which caters to the HNIs and UHNIs, that also be making your job difficult. So if you can tell us what value a firm like ASK adds to this, this space.
The usage of technology? Is that
No, my point is since technology is sort of democratizing investing, for a firm like ASK, which has to sort of do a lot of advisory, what value does you add?
So Ultra HNIs, it's still very one-on-one, personalized, customized, relationship-oriented business. HNI for us is a phygital model where we are using digital technology along with relationship managers. But for both the models, for us, technology is about how to add value to clients, be it portfolio analytics, observations, onboarding, servicing, many areas which today are manually dependent. So the idea for us, the final objective of using technology is how can we improve the productivity of a relationship manager in a way that he can handle many more clients and spend more time on relationship management rather than back-end work. So there are lots of AI-oriented technologies we've integrated within our system. A client, if he gives us details of his portfolio, we don't need a portfolio analyst to sit down and come up with analysis of which fund is doing well, not doing well, how to move portfolios, what is the risk. So all of the analytic part is done through technology. Then we use Microsoft Copilot, where we feed in all data and we've been training our machines, any detail of products across all asset classes, because many relationship managers are not fully trained. They can get all the information, comparison, and now we are integrating it with our mobile app so that even a client can get all the information he wants. He need not call a relationship manager to ask him, hey, listen, I need some money off my portfolio, which fund should I redeem? Automatically using AI, the machine can tell him that he can exit out of ABC fund because it's poor performance or exit load is lower, etc., etc. So for us, technology is an enabler to improve productivity, to make sure that the RM spends more time with clients because HNIs and Ultra HNIs still want that. And while democratization of funds is happening for the mass affluent, we still feel that many of these products are not suitable for the mass affluent. For us, when someone has surpluses, the investing should be easy and simple. The best way to play India's growth story is equities, and a good combination of equity fixed income, where many people are still underinvested because they've either been buying real estate or gold or FDs. They can easily meet their long-term financial goals instead of trying to get into very fancy products, which Ultra HNIs today want because their risk appetite is higher, their portfolio size is larger. So some portion of their allocation, they're willing to look at private deals or geographical allocation or get into alternate products, which frankly for us are not suitable to a larger client segment. So that's, each house has a philosophy approach. There's no right or wrong, but finally, for us, technology is about how to provide the service to clients at a much faster way, more analytics, and get our RMs more and more productive.
Rahul, if I can ask you the same question, what value can a wealth management firm add to somebody who wants to, invest a big sum in them?
So, I would say that from a wealth manager point of view, generally why I think the basic premise is that why a client comes to us and what does he want? He wants someone who can help him compound his wealth over a period of time. This is, if you look at it, is a long journey. It can't happen in a year, 2 year, 3 year. It has to have a consistent, disciplined approach coming in. So, for example, when I was saying that asset allocation more than anything else, it's a best EQ mechanism because end of the day, as a investor, and where there is so much of information coming in, where TVs are constantly telling you, your friends are constantly telling you, I think you get distracted. Suppose you have built a equity or SIP portfolio for 10 years down the line, but if market goes 10% here and there, you will say, I want to wind it up, hypothetically, correct? So getting a consistent and disciplined approach is very critical from creating compounding from wealth point of view, if you're looking from 10, 15 years of horizon. That is where a wealth manager comes and helps you out, giving you a guardrail saying that don't get disturbed, it is the right time to do some allocation here and there. And I think that conversation becomes very meaningful. Another important point is that in the current market context, every investor has multiple wealth managers. And most of the conversation right now are limited to product. It will become more meaningful from an investor point of view to move into a portfolio conversation. That how is your portfolio compounding over a period of time? And I would say that these are very essential part from creating long-term wealth. And there, I think a wealth manager plays a very important critical role. Apart from that, if you see from the current market landscape, there are a lot of mutual fund schemes, mutual fund companies, AIF, PMSs. What suits you best is also where a wealth manager plays a very important critical role. And because it's getting overcrowded right now. And a client can get confused very easily. So that is also a very important role where picking up, choosing the right product category, right product set among the category also becomes important. Because end of the day, the aim for a wealth manager, why the client comes to us is also that someone who can generate an alpha for me, someone who can generate better returns than FD or other equivalent asset classes. That is the core work and how I can create compounding over next 10, 15 years.
You said product is a key talking point. What about fees? Are fees is something that sort of helps one firm differentiate from the other? Srikanth, if you can. And given the competition as
I was not the first one to go on that question, but look, we are a cost-sensitive nation. I don't think that's any big surprise. But also in some sense, you have to look at the question of fees in terms of what value you can add. I think most of the time this question is valid or invalid, because if you're just adding a very commoditized kind of an approach or a service, you'll always be challenged to the fees that you can charge. But I think most of the, and I can talk for at least the panel sitting here, I think if it's a very purpose-based service that you do, if you can add convenience using either technology or high-quality domain services, using your own in-house research to add alpha, as some of us said, I think as long as the customer can see through what benefit he or she has by employing a wealth manager, I don't think fees is an issue. And on the other side, I think we've really seen the regulator disintermediating the industry to some extent. And when I say disintermediating in a positive way, that they do believe that cost needs to be more rationalized for the investors to have a slightly wider financial inclusion. So we don't look at fees as something which, it is an issue given the fact that there is overcrowdedness, but it is also pushing all of us to go back to the drawing board. And instead of saying that can we have a race to the bottom, the discussions are now shifting towards the fact that, look, if you have to charge fees, what's the justification to it? And I think that there's only one winner, which is the investor. Because now, after a long time, the discussions are back to the boardroom where you are justifying what fees you're charging and for what reason. And if you have a good, solid justification, I don't think having a transparent fee is absolutely of no issue.
Rajesh, would you like to add anything? What are the key talking points? Is it fees that differentiates one firm for the other, or it's much more than just fees?
No, it's not. If you're adding value, people are willing to pay the fee. It's also become very transparent, so clients also know. Even if you don't tell them, competitors will. So you have to be sure that you are in the game. And you have enough and more investment ideas through which you can generate significant amount of fees. So I don't see fee as a big challenge. Having said that, in our business models, we've always assumed that over a period of time, you have to play the game of scale because fees will get marginalized in some way or the other because cost of hiring is always a challenge in the industry. You don't find talent. So as Shrikant mentioned, the model is of investment bankers when it comes to cost. And while fee paying, there is a limit to it. So 50 to 60 basis points is a average fee a wealth manager makes. And that's what has been built in the model. And you also assume that if this were to go down, because globally, if you look at all wealth firms, they earn without leverage about 30, 35 basis points. And then they use their balance sheets to make more money. And most of them are making anywhere between 70 basis points to 1%. In certain countries like UK, the regulator has come in and defined the fee. Yeah. So if you're a accredited investor, you can have a bilateral arrangement and charge whatever you want. But otherwise, for all advisory, they've capped it or they've put it as 0.75. So they've made everyone on the same sort of platform. And then it's about how much value you are adding in terms of services and products for which the client will give you money. So we may also move there. I think the regulator has a lot to do in the wealth management space. It's highly unregulated. People sell all kinds of products. There's no accountability. Half the relationship managers, are just sales guys. I mean, if you really drill down, they don't understand half the products. Anyone can become a relationship manager, and today anyone can ask for any kind of salary. So I think there is a time to, for this industry to get regulated, accountable. RMs should have certifications. They should have definitely some credentials before they can go and give gyan to others. And after that, even wealth management firms should have accountability in the way they drive the entire business model. So I think it will happen. It's a matter of time. 20 years back, there were 4 firms. Today, there are 25 firms. And as the industry grows, I think regulator will play a big role in trying to build credibility behind this industry.
That is a very important point. Rahul, what would it take to improve the quality of relationship managers and the touch points that are there?
I think that's an interesting one, and we grapple on this every day. So I completely agree with Rajesh that end of the day, it's our fiduciary responsibility towards the client to be true to them. I think the wealth manager plays a very important critical role here, effectively. I would say that it is the overall culture and ethos of the organization also which drives the organization and drives the wealth manager. Because at the end of the day, if you keep asking revenue from him every day and you expect him to do something else on the ground, it will not happen. So first, the culture has to change from top down. I think that is one of the first and foremost things where you have to be comfortable in the space and don't expect moon out of them from 6 months, 12 months, correct? That is one of the things which is important. Another important thing is that if you can build a efficient cost structures, then automatically the need from wealth managers, like what Shrikant was alluding to, it's an important one. Third is that learnability and pushing the individual from learning point of view is also critical. So for example, we keep talking in our organization very regularly that end of the day, if everyone gets a gym subscription, I think 90% will still not end up going. So you can't force them. But learning is something which we have to force if the individual has to stand in front of a client. And everything can't be just explained or sold to client on relationship basis. I think it is very important for him to understand the product category, understand the asset classes, understand the asset allocation, and then speak to the client. And as what I was saying earlier, that this whole discipline as a process for client from portfolio thinking, etc. is also very important. A wealth manager work does not get over when he sells a product and his work starts again when you want to sell it again. I would say his journey starts from every 6 months doing a portfolio review with clients. That is the most critical part. In that process, if he ends up doing something with the client, is ancillary. That is the thinking which needs to be done. And I am a firm believer that since we run a very large franchise from people point of view, we have more than 1,000 RMs. I think that is where we are trying to work, where we are using technology to help them from learnability point of view, create a more robust process so that there are counter checks from governance point of view. And third, building a culture where he automatically gets aligned to the client. And I'm sure that if someone, so I would say that obviously you can't change it in a very short period of time. It's a very evolving culture from point of time. But if you will consistently keep working on it, you can have significant improvements.
Thank you. We'll go to the audience but before that, if Anas, you can tell us whether how smaller centers are now, coming to the fore, and or is it just sort of where is all the action in the big cities, or even smaller centers are now sort of.
So I have this. So today I was talking to Rupert Hojwa, who's a global chairman of Huron. So he was going to a place called Yangon, it's like a panchayat inside a place called Wuxi, which inside like a state similar thing called Jiangsu, right? Like a small panchayat. He was saying in that small province there are about 65 listed companies from that small place, right? So that's in China. For India, just to give you a context, when we launched the list in 2015, we could find some 25 cities, towns, villages beyond the metros from which we could find the rich list entrants from. That number is 113 now, right? And number of individuals in these cities, it was 87 in 2015, now it is 755, with a net worth of 1,000 crores and above that we could find.
These are beyond 25?
Beyond the metros. Beyond the metros. Total wealth of these individuals beyond the metros, that was 7 lakh crores in 2015, now it is 16 lakh crores. There's people in the rich list. Number of dollar billionaires, that has grown from 33 to 125. Again, now, ASK, Private Wealth and Huron, we do a list called the Future Unicorn Index, where we've defined startups called cheetahs, which are those companies with a minimum valuation of $200 million and which could potentially go unicorn. This kind of shows the future of startup ecosystem, right? That number, Rajesh, was about 32 when we started the list 4 years back, and number is now 63. That's gone almost double as well. So if you look at the overall wealth creation beyond metros, that's quite interesting. And also look at the sectors from which this wealth is being created. You've got industrial products, you've got construction and engineering. So there are local manufacturing heroes, local real estate like sectors which is predominantly local. A lot of the such industry that's really popping up from these tier 2, tier 3 centers.
It's quite amazing that even smaller centers are contributing. We have time only for 1 or 2 questions, but very quickly, if you can.
Hi. Thank you, everyone. Basically, putting across some light to the investment part. I'm Vikram Mehta, representing Lawrence Grant Advisory UK. Rajesh, specifically, the way you guided just now, people are going from here to US. But what we generally found in last couple of years, looking at political scenario in India, people want to come back to India for the sake of investment, the growth of Bharat, looking at that thing. How is a wealth managers or wealth company you all see on that line?
So I was talking about investment diversification, because you have a Wells Fargo in the US and you have a HDFC Bank in India. Business models similar, but we still don't have the Microsoft, Nvidia's, Apples of the world. So as an allocation to equities, many of the ultra HNIs look at 5-10% of their portfolio getting allocated to the US markets along with emerging markets, where there is still a significant opportunity. And from an asset allocation perspective, India is not doing well. You'll also have certain portfolios. So India's market last year was flat, but in the US market, the returns were 27%, right? So that is the idea. But having said that, there is a huge amount of interest. We have an office in Dubai and Singapore that caters to NRIs and foreign institutions. I've never seen this kind of attraction towards India. And that's also one of the reasons Gift City model is becoming a very attractive one. So clients are looking to invest. Currency is always a challenge. But today, no one can stay away from allocation of India. And all the parameters, 2,500 discretionary income, aspiration level, size, we all know the story. Plus, I think, the political stability over the last 3 terms, digital infrastructure that India has created, physical infrastructure that we are investing in, these are absolute solid stories, and brand India has never been stronger. So there is a lot of interest to come back into India.
Very sorry we have run out of time, but we can have one question. Yeah, please. For mic, if you can give the mic. Just one. Yeah, please.
Hi, this is Girish and Nani here. My question to you, all of you, and any one of you can take that question. Which is the asset class which has moved drastically? You see the growth coming in because, and especially with the topic where are the rich investing. So, which asset class do you think is moving fast forward, and you think the allocation to that particular asset class is increasing as compared to the other asset class? And where do you see this going from here? Which asset class would be the future could be? I mean, equities we've seen, mutual funds we've seen private credit coming in. What is the next, or what is the next big thing? We talked about crypto also in the morning, and we heard about that as well. So where do you see, and what is the next asset class or next big thing for the ultra HNIs and the HNIs of the country? Thank you.
Also, yeah, please. Also, my colleague Vinu reference to art and various new forms of investing. If you can also touch upon whether those are also being looked at.
I think that Rajesh can touch upon. So I would say that if you look from an Indian context point of view, we as a group believe that real assets will do well in coming couple of years. So like gold, silver has been doing well. Commercial real estate looks good. Something to do with infra, REITs and all will do well. So one of the asset categories which we feel can do well is InvITs and REITs, which is still evolving. From Indian context point of view, infra, power and all, where InvITs, REITs come in, there has been a lot of investment already happening and a lot of public money coming in there, and it's actually fairly I would say risk-free, not the right word, but less risk and a decent returns there. So that is one of the asset categories where there is a lot of liking which is coming in, and it might find a lot of interest. I think regulators also started doing some work there. So for example, now REIT has become from equity from taxation point of view. Something similar can come in future on the InvIT side also. So this is one of the categories which is annuity in that sense, generating fixed income, very predictable, lesser risk, and it sets with an Indian context point of view where a lot of investments are also going. So we need more capital there. Like the domestic helped India in the equity point of view in last 2.5 years. We have been seeing consistently. I think this can be the new category which can grow really well.
Rajesh, anything to add?
Right. So for investors, by far equity is the best asset class, right? We have to just make sure with all our clients that they don't get carried away by FOMO and start investing and going all over the place. But having said that, REITs, InvITs, commercial real estate, very good asset class. All government assets and private assets getting monetized through InvIT gives you decent fixed income return. So that by far, I would say the alternate space, which was missing in India, it was largely fixed income and equities, but the alternate space, private equity funds, your private credit, real estate, REITs, InvITs, this is a very strong emerging asset class for ultra HNIs, including private deals and private transactions, pre-IPO, businesses like data centers today or, companies before they get listed. There are lots of opportunities that are available for ultra HNIs who want to take serious amount of risk. And that too, we cap it. Maximum allocation to such products are not more than 10% of any client portfolio.
Anything to add, Srikanth? Or,
I think both Rajesh and Rahul well covered, but just to answer factually, what we are seeing is a change, while I don't think we'll disagree to what is the right thing, but factually the three things that have seen the maximum uptick in the last half a decade or so is global diversification. I think Indians are trying to max out wherever possible, either through feeder fund routes, in mutual funds, or through LRS, or now OPI is a big topic of discussion, especially in the UHNI closed circles. So we're generally seeing a huge uptick in interest towards diversification in global assets. The second is alternate space, and specifically within alternate space, private unlisted companies have caught a fancy, while we all know that it's risky, but it's in some sense also coming of age for a country like India. We need to have our Silicon Valley kind of moment, and I think if smart, intelligent capital chases some of these assets with, of course, all the guardrails and risk, I think in some sense it's also healthy. And last, we are also seeing a reasonable uptick happening on passives, where a lot of people are realizing that a low-cost product which gives you similar risk-adjusted return through passives. So in my, at least, experience the last 5-6 years, irrespective of what is right and how we guide, keeping that question aside, but where we see a lot of questions coming is global diversification, passives, and unlisted is where a lot of queries coming through.